Hello investors. In this video, I would take you through some of the outcomes of our disciplined investment process which we have followed in Quantum Long-Term Equity Value Fund. In order to evaluate any fund, it is a better way to evaluate the fund over multiple market cycles. A cycle is comprised of a bull phase where the market moves from bottom to its peak, and a bear phase where it retraces down to the next market bottom. So here I have considered the performance of Quantum Long-Term Equity Value Fund against its Tier 1 benchmark. So the first bull phase is from March 2009 to November 2010, where the fund has delivered returns similar to its benchmark. In a bull phase, over the late stage of the bull market, typically valuations becomes quite expensive. And in many of the portfolio names, which has turned expensive, the fund manager would have started trimming those positions. As a result, the cash level tends to move up. When the next bear market starts, in this case from November 2010 to December 2011, the higher cash levels which the fund has raised during the tail end of the previous bull phase and the relatively less expensive names in the portfolio would help it to fall lower than the broader markets. In this case, the fund has fallen by 20% compared to 31% of its index. In the next bull phase, the same trend continued, where the fund delivered close to its benchmark returns. And the upcoming bear phase, it has fallen less than the benchmark because of the higher cash levels and relatively less expensive names in the portfolio. 2016 to 20 was an exception, where the fund underperformed the benchmark by a larger margin for two precise reasons. One, there was a corporate tax cut which did not benefit many of the portfolio holdings which were into utility and certain export-oriented sectors. And these stocks were already at a lower tax rate, because then therefore they did not benefit from the tax cut which the government announced. Plus, the earnings growth in general was quite muted. The rally was fueled by an expansion in the valuation multiple, which a value fund may not be able to participate to the full extent. And when the next bear phase happened, we fell almost close to markets. This was a very short-lived bear cycle, which happened during the COVID fall. And typically what happens is in the initial phase of a bear market, the fund manager tends to liquidate all the large cap liquid names where the fund has a higher share. And as the bear market prolongs, you would see larger drawdowns in less liquid names. And coming to the current ongoing cycle, the fund has delivered better than the index returns. We have seen some sort of volatility in the recent times, which is reflecting in this longer term outperformance, but the drawdown or the down market is not large enough for us to show it as a different cycle. So if we were to compare it with the Tier 2 benchmark BSE 200 and a large cap oriented benchmark BSE 30, these are the results. The trend is similar, but of course, when we compare to a large cap index, the outperformance could be slightly higher in certain periods where the rally was more fueled by small and mid cap names. So if we were to analyze any fund over a long cycle, there are two critical ratios which helps us to capture those performance. Up capture ratio captures the performance of the fund in a bull market or in a trending market where the market is moving up. So if the market moves up by 100% and if the fund moves up by 80%, the up capture ratio is 80%. Similarly, in a down market, if the market falls by 10% and if the fund falls by 7%, the down capture is 70%. And over long periods of time, if a fund manages to capture a higher up capture ratio compared to the down capture ratio, the fund is likely to outperform. And here is how that ratio looks for QLTEVF since its inception. The up capture ratio is about 87%, which means we have captured about 87% of all the up moves compared to our tier 1 benchmark. And this is computed based on monthly returns. And when the markets were falling, whenever the markets gave negative returns, the down capture ratio is about 76%. And since the fund has managed to capture a larger share when the market goes up versus how much it lost when the market was falling, the long-term performance or the long-term outperformance remains. So if we were to compute this ratio compared to our tier 2 ratio benchmark and the Sensex, this is how it stacks up. The trend is quite similar. And because of this better up capture ratio compared to down capture ratio, over long periods of time, the fund has been able to outperform its benchmark, and that is reflected in its performance here. So thank you so much for patiently listening. I hope this video has helped you to evaluate funds over long periods of time. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.